bond divergence of 2024. Hi, it's Charlie giving you the weekend video. Hope you're very well. So I've actually brought up, there's a few things to talk about here with regards to the bond market. So when we're looking at the bond market, we tend to look at the 10-year note. And so what's going on in the bond market at the moment, or over the last few years, we've seen a massive sell-off in bonds as interest rates have risen on the back of rising bond yields. Why is this important to you in your trading? Well, if you trade FX, anything to do with the dollar, if you trade the stock markets, everything's influenced by the bond market here. And so the bond market actually made a low. Bonds made a low back in October of last year. And if I zoom out a little bit, you can see that the bond market going back into the earlier 2000s, when we came back into October of last year, you can see it came into this historical lows around 2006-07. Okay, and as we can see, the bond market has bounced. If I zoom back in a little bit here, we've bounced into the back end of the last year, and then bonds have started rolling over again this year. So as bonds come down, bond yields rise. Bond yields rise. Stocks don't tend to like that so much, but the dollar does, and so the dollar will go higher. And quite often we'll see the stock market come back off. So what about this bond market divergence? What are we talking about here? What's the divergence here, Charlie? Well, there's a few. First of all, there's a technical divergence going on down here from when the bond prices bottomed in late 22, before that first bounce there, into late 2023. And the potential is that the bond market comes down and makes another low here. I'm recording this just several days ago because I'm away on a short break, and so this data that I've got on here is as of the 1st of May. And so anyway, we'll see. This is a monthly chart. So whether bond prices do come down and make another low. If they do, and there already is one in place, we are diverging down here technically. And where is that? Hold on a second. Let's just put an MACD on. So you can now see that on an MACD, simplistically speaking, we can see whether it's on the histogram here. We can see the histogram was in the red back at this low, and it's turned green, and or certainly even at this low, it's a much higher low as far as the red histogram is concerned. But if we look at the MACD lines itself, which is even clearer, we've got a low here, and then on the blue line we're looking at, and then a higher low here, even though bond prices came lower. Okay, so there's a technical divergence. However, there's more to this. We've also got, if we look at what the large speculators are doing, like hedge funds and the likes, and large speculators in the COT report, the Commitments of Traders report, if I just bring it over a little bit here, we can actually see something that's interesting going on. If I zoom in a little bit into 2024, we can see that actually the large speculators, although they're net short, as you can see, even as far as their price, where they're positioned at the moment, they're still significantly net short. They're just a lot less net short than they were back in January or so. So we've seen a bit of a divergence between their positioning and what bonds are doing. Bonds are falling, but their positioning has not been. It's actually been, they've been reducing their short exposure rather than increasing it as bonds are falling here. So again, a bit of a divergence. If I move this, sorry, if I move the screen back over. A bit of a divergence between what large speculators are doing and the bond market itself. So the thing is, you can't time what the speculators are doing, the large hedge funds and the likes. You can't time what they're doing. It's just given us a bit of a flag that they're not chasing the prices back down. It's not that they're not short, because they certainly are, but they're not at the same levels of short interest as they were even in earlier 2024. So there is a divergence overall between what they are doing and what the bond market is doing. What does this suggest? Well, what it does is it tells us that one or two things could go on here. And I'm going to talk about sentiment in a second as well. Bond prices could continue to fall and make a new low here into this big support zone down here. So we could still see new lows coming in here. But what would happen is we'd probably still be diverging technically on this big picture here. Plus we know that large speculators are not, it's highly likely that they're going to be at new lows in their short positioning. Hence there'll be a continued divergence between what they are doing and what price is doing. Plus we will have that divergence overall on the monthly chart here. Added to that, there's a huge amount of speculation with regards to the bond market. Just this today. Extreme bond market shorts gamble on a hawkish Powell pivot. So hedge funds, etc., have got bearish positions, as it's saying here. What I can already see in the COT report is that hedge funds are less short than they were. Like I've just said, a divergence, but they are still, of course, short. And then there's a risk of bigger treasury. So big headline stuff here from a sentiment perspective. So we've got the backdrop of falling prices with heightened sentiment going on coming into this. So what does it mean? Well, what you need to do is look for at the technicals. At the moment, it does look likely that bond prices will continue to come down. If bond prices continue to come down, that means yields will be going higher, which means that it's more likely to see a stronger dollar. However, watch out if bonds do get down to new lows, because they could diverge down there, and which isn't that far away. So maybe in a month or two's time, we find that they've bottomed out with a nice big divergence going on there, with the backdrop of hedge fund positioning not being fully short anymore, and a lot of sentiment speculation, news headlines and the likes. And could we down here actually be in the right position to form a medium-term new low into historical support as well, and therefore start to see the bond market rally? Now, if that happens and the bond market rallies, that means that bond yields will be coming down, which means the dollar is more likely to then be coming down as well. So all of that marries together for at some point in the future. So just keep an eye out on the COT report there and the technicals of the bond market and of the dollar as well. And all of this will also feed into what? The stock markets too. So if bonds start going up and we see a bit of a relief in bond yields, that could benefit the stock market as well. It's not always the case. When bonds go up, that sometimes means that market participants are getting fearful in in other areas of the economy, and stocks come down. But we're in a different world right now, and so we could see bonds going up, which actually also favors the stock market as well. So there's lots going on here. It's a bit of a technical video here this week, but it's certainly something to consider as we go forwards. So obviously I'm recording this on Fed Day. I don't know what Powell is about to say, because I'm recording this in the morning of Fed Day. But we'll see what happens. But it certainly at the moment looks like bonds could come down and make a new low down here over the next month or so. But if they do, and then we get a bounce back up, that would complete a potential divergence there on the big picture, which could then, going into the second half of this year, start to see the bond market start to creep its way up. And if it creeps its way up, that could be good for stocks, and it could weaken the dollar as well at some point in the second half of this year, coupled with, of course, an election coming as well. All of that there too. So just something to consider there this week, something a little bit different with regards to the bond market.